Well, hello traders and investors. Today is November 25th. We're in the last week of November. We've got a lot of data come out today. I wanted you to see this. Tomorrow the market's closed. We've got the Turkey Day, but today we've had durable goods, GDP, international trade, jobless claim, corporate profits. I call it the kitchen sink day. Let's talk about the big reports. First of all, durable goods. Durable goods came out a little bit better than expected. Let me show you the numbers here. The expectations were 0.9%. The actual number was 1.3%, which means durable good orders are actually picking up, which is better than expected. But GDP grew by 33.1% as expected. U.S. economy rebounded at a pace of 33.1%, unchanged from the first estimate a month ago. But a resurgence in the COVID-19 is expected to slow down growth sharply in the current quarter, with some economists even raising the specter of double-dip recession. Biggest gains in business investing, housing, and export were offset by downward revisions to local and government spending, business inventories, consumer spending. The 33.1% gain was the largest quarterly gain on record going back to 1947, but remember what we're dealing with before that. So this is a bounce. So again, I wouldn't make much of this because this is just a simple bounce and we need the number to go higher. But here is the biggest problem. And if this continues, then this GDP is going to go down very, very fast, because look at the jobless claim numbers, 778,000. And here's the problem. If you look at the jobless claims data, and this is a biggie, you will see that the moving average is about 742,000. This is new claims. So the moving average has been going between 1,000,001 and 750,000. It can't break, and now it's higher than expected, or on the upper end of the range. As you can see here, the range is 700 to 780. We came in at 778. This is bad. This is telling us that America is having a very, very hard time holding employees, and that there's a lot of unemployment right now. And if this continues, and it looks like it's going to go, it's not going to be good for the economy. It's not going to be good for consumer discretionary spending, and so forth and so forth. So this jobless claim is a big number. Let me read the report to you. The number of Americans applying for unemployment benefits rose last week to 778,000, evidence that the U.S. economy and job market remain under strain as COVID-19 cases surge and cold weather heightened the risk. And the Labor Department reported Wednesday says jobless claims climbed from 748,000 the week before. Before the virus struck in March, weekly claims were roughly 225,000. So they're 3 times higher. They shot up to 6.9 million during the 1 week in March before dropping back. But 8 months later, we're still near historic highs. And number of people who are continuing to receive traditional unemployment benefit is now 6.1 million. Up from fewer than 1.7 million a year ago. So the number is terrible. And again, it went down from like 1 million to 750,000, 800,000, but it's still really high. And folks, if people are filing unemployment benefit, that means they don't have jobs. And if they don't have jobs, they don't have money. And if they don't have money to spend, then how can GDP growth, which is accounted by 3/4 of retail sales, continue to go up? It can't. So that is a major, major, major issue. Now, that's fundamentally. Technically, I want you to see the put-to-call ratio is now at 0.64. And if you look here, let me go back. This is 9 months. Let me go back 11 months. The only time we've had it lower, look at February. Look at the crash we had. We went all the way up, and then we couldn't go lower. The market is extremely bullish right now. And if you look at the indices, you will see that the NASDAQ 100 is higher. The reason it's higher is because the unemployment data is so weak, which is encouraging a rally in the stay-at-home stocks. Remember, NASDAQ 100 is the capital of the stay-at-home stocks. Let me show you some stocks that are in the NASDAQ 100 so you could see what I'm talking about. This is the S&P 500, but let me show you the NASDAQ 100. Tesla, Zoom, Align, Expedia. Expedia's not, but again, JD, Qualcomm, Lam Research, Melli. These are stay-at-home stocks. The only one that's not a stay-at-home stock here is Expedia. That's it. And if the jobless claims continues going higher, I could assure you, Expedia is going to be going down. So again, I wouldn't focus on Expedia too much or Marriott because again, if jobless claims go 775,000 new claims, people aren't going to have money to go to Marriott or book travel plans with Expedia. So again, remember what I told you, we're at a crossroads right now. It's kind of like one day where we're at is this: whether the COVID-19 levels spike sharply or the vaccine comes out or economy can stay moving till the vaccine comes out. And every day it's kind of like depends on the news, depends on what's coming out. And as I said last few days, if the vaccine came out a month earlier or if we were in September, early October, I wouldn't be as worried right now. But we could be in store for another stay-at-home period. And if that's the case, the NASDAQ will rally. Now, I don't think that's going to happen. I think the market is going to start looking further and further ahead, and the stay-at-home stocks will start cooling off. But if there's a delay in the vaccine, if the jobless claims continue to spike, if unemployment rates continue to falter, if retail sales begin to weaken, all of these things can change the dynamic. So again, we're at a crossroad. We're like in front of two different freeways. Are we going to go back to where we were last February, or are we going to go in this new environment? And again, every day it depends on the news and the data. I'd like to say, like yesterday, for example, the stay-at-home environment was losing out to the new vaccine is going to be out. Everything's going to be back to normal. Today, things look opposite. Today, it's going back. Stay-at-home environment's winning, as you could see by the NASDAQ rallying. So whenever you see the NASDAQ 100 outperforming all the other indices, it means that investors are getting scared and stay-at-home stocks are persevering or outperforming. But again, I wouldn't be too bullish right now in light of this put-to-call ratio. And it's telling us we've got to be very, very cautious. We've got holidays. We've got unemployment numbers rising. You've got to be very, very careful right now. Be very, very careful. Now, before I let you go, I want to show you a new stock that's on my hit list that is brand new. And sometimes, as you know, they stay on here for a while. The stock is HWM. Let's look at this. HWM. This is a new stock on the top list. Howat Aerospace. Now, big red flag. It hasn't taken out the February high. So if a stock hasn't taken out a February high, I'm just going to watch it very carefully. But again, you should know that this is a new stock that's on our CSI scan that I haven't seen in a while. Most of these have been on here for a long time, like Freeport, FCX, Coach, L Brands, Gap, which had negative earnings today, FedEx, Harley, Alliance Data Systems, General, Discover has been in here. We've been long Discover for a while. Nordstrom's, all these stocks have been here for a while, but they're not a surprise. But this one, HWM, is a surprise. And again, I wouldn't get too excited about it till it takes out the February high. If you're looking at a stock to go long, it's probably a good idea to see that it took out the February, January high, because that means it has shrugged off the current economic cycle. If it has not taken out that high, that means it has not. So keep that in mind. Ticker symbol HWM. It's going to be a stock that we're going to add to our watch list. Now, a rare, very lucrative gold profit opportunity has just triggered for the first time since 2000. And folks, the market is overbought right now. Did you see that put-to-call ratio? I mean, look at this thing. The market is overbought. And when markets go down, guess what commodity rises? Gold, and more gold. And this rare setup could pay nearly 10 times your money or more, and as much as 48 times more than buying physical gold. Man, I love the way this sounds. I got to get in on this. The last time this window opened, a small handful of players saw gains as high as 2,700%. That's like turning every $1,000 into $270,000. If you're ready to discover everything you need to know about this rare second chance opportunity, click the link below. Don't miss out. This may be the perfect time to buy gold in light of these put-to-call ratios. The market is overbought right now, folks. Look at this put-to-call ratio. I challenge you to look. Anytime it's been at 64, it pulls back and gold rallies. And gold's hitting the 200-day moving average right now, which means it could be up for a nice bullish move. Hope that helps. And folks, remember, I want to read your comments. Give me some feedback. Like this channel. Have a great day, and be careful with the turkey tomorrow. Don't eat too much, or you might be comatose for Friday's trading session. I'll talk to you guys later, and have a great holiday day off away from me and everyone else, and stay away from the financial markets. Just do something fun, eat some turkey, have a good day, and spend time with your family and friends. And I'll talk to you all later. Bye.